Today I wanted to talk about the current investing opportunities in my broad idea on the stock market, like the USA, China, and Poland. So I am saying that right now some of the valuations of some of the companies like Magnificent Seven are very high, not to everything, but to some of them. And also that the current PE ratio of the S&P 500 index is quite high compared to old school values. So if you look at the S&P 500 PE index that should be seen on the video right now, you can see that for the past 100 years, starting from 1880 till 2000, the PE ratio was around 25 to 10. It was moving around. The mean value looks to be around 15. And right now, the PE ratio of the S&P 500 index is 28.4. That's the March of 2024. So that is nearly the double PE ratio that was seen in the past before the year 2000s. And if you zoom in and look only at the last 10, 20, and 5 years, then that PE ratio doesn't seem to be so high. We have seen much higher readings of the PE ratio in the near past, in the years 2000 and 2020, 2021, etc., etc. But right now, that PE ratio is still, in my opinion, very high. When you look at the chart, it becomes apparent that it is. And this can be optimism of the markets or some survivorship bias because of the huge growth of the United States economy in the past. People can think that growth will continue throughout the next 10, 20, 50 years. Or maybe they are just speculating that the next months will bring the price higher. That we don't know, and it's very hard to tell the reason that is really behind the movement of the money on the stock market, but that doesn't really matter. What matters is that the current valuations are very optimistic, which should get you worried actually. And it also is accompanied with the huge stock market price, also the movement upwards on Bitcoin and on some crazy stocks like Nvidia. On the Polish market, I will look at the PE ratio of the WIG20. WIG20 is the biggest 20 companies in Poland. The current PE ratio is 17. And if you look at the past performance of that indicator, it's around the middle. So there's no spectacular opportunity like there was some time ago at the beginning of 2020, where the PE ratio got down to very low levels of 7, actually, if I remember correctly. So that's really, really low. And now the PE ratio around 17 is moving towards the highest range. But the important thing is that the WIG20, the 20 biggest companies in Poland, are majority are owned by the state, and usually the management boards are filled with politicians. They are there not to do their job, just to get the money, and that really, and other things of course, but really slows down the growth of those companies. Also, they are the biggest, so they're usually slow growers, but state ownership doesn't really help. So connecting the PE ratio of 17 to the slow growth of those companies is not a very good place to be in right now, if you know how to analyze companies on their own. So if you are just looking into the stock market index, into the ETFs, and you are trying to buy them, for the Polish index is still a perfectly fine place to buy if you are not looking for some crazy opportunity or just $3 cost averaging. So next I wanted to talk to you about a little bit about Magnificent Seven. So the Magnificent Seven now is taking part of 27% of the S&P 500 index. Stocks like Nvidia, Meta, and Amazon has grown much more rapidly than the S&P 500 price, and that also leads to higher valuations. So that growth is not connected to higher earnings of that companies. That growth is connected to the speculation of higher earnings in the future. I think because of the AI revolution, and of course that can happen, but for Nvidia, for instance, for the stock price to really reflect the real value of the business in the future, the growth would have to continue for 40% year to year for the next 10 years, and that's just not okay. It can happen, but it's very, very unlikely. So right now the P ratio of the Magnificent Seven companies, the average is 45.7, so it's really not that good compared to not so good S&P 500 PE average of 28. That 45 PE rating is just terrible. There are some companies like Google that has much lower P ratios, so that's a nice place to look at. And companies like Amazon, Nvidia, and Tesla, they are hovering around 40, 50, 60 in terms of P ratio. So of course those readings can happen. It's normal that some companies are so heavily undervalued, and for Tesla actually the current PE ratio is much lower than it was in the past. So in here we can actually see the price drop. So there can be some speculative opportunities connected to the Nvidia stock, going short, so selling the stock maybe with options. It depends. It's very difficult to tell, and also the high valuations can stay on the market for years even. So it's not something that can be predicted in the short term. And lastly, let's walk into the opportunity side of this. Currently, the Chinese market looks, in my opinion, very cheap. The P ratio of major indices is around 10. There are some huge companies, and the price doesn't reflect really fundamentals. Also, if you look at the difference in the stock price of S&P and some Chinese indexes, for instance, till 2020, the S&P moved plus 60%, while ETF like XCS6, that's a German ETF for the biggest technological companies from China, moved minus 26%. So here we are actually going down. But this is not connected to the fundamentals of the business. If you look at the P ratio between Amazon and Alibaba is connected to AliExpress, etc. They are kind of in the same sector. So Amazon has the P ratio of 61, while Alibaba has P ratio of 13. And Amazon has PB ratio of 9, while Baba has P ratio of 1.3. So the current stock price movements are not connected if you compare those two. Of course, you can really compare between different markets, but I would much rather invest in something that it has PE of 13, not 61. Okay, thank you for listening. And remember, this is not an advice. I just mentioned some examples. This Alibaba or the XC6. XCS6 German ETF. But those are just examples. So nothing more than that. Not a financial advice. Thank you for listening, and I hope to see you in the next episode. Bye bye.